Welcome to the seminar about future contracts, basic hedging speculation, and real-world application. I am prop trader working for company Positive Equity for almost 6 years. Before start or to begin, I will give you a presentation summary. First, we will talk about Positive Equity, what we are doing. Then after that, I will give you, can you hear me, everybody? I will try to, čekaj da zatvorim vrata, klima radi. Okay, I will try to speak a little bit louder. Is it fine now? Okay, it is because of air conditioning or what? Okay, here is a presentation summary. Then after Positive Equity, we will talk, I will give you introduction to futures. After that, we will talk about supply dynamics and the demand in futures trading, then market structure, and after that, I will briefly touch a little bit about psychology of trading. Okay, about Positive Equity. We are a prop trading firm located in Dublin with offices in Split and Zagreb. We are a team of about 40 professional traders. Our main goal is find talented people, constant sharing of new ideas and strategies in our trading office. We like to put emphasis on our traders, and we are giving opportunities for career development via trainer, trader, analyst, and independent junior or senior trader. One of most exciting things that we are offering is internship program with run in June and August and last for 2 weeks. And during that time, you can try to trade on market via trading simulator. Every day there is morning and afternoon session, and every day you have somebody who is mentoring you and teaching you about markets. I went to the internship program, and every time when somebody asks me about company or about trading, I tell them about this internship program. Okay, now we will start with the topic. First, we need to know what are derivatives. Derivatives are financial contracts whose value is derived from the value of underlying asset. We have 4 types of derivatives. First one are options. Option is a right but not obligation to buy or sell specific asset at specific price in the futures. Then we have swaps, forwards, and futures contract, and 3 of those are almost the same. And those are futures contracts are a legal agreement to buy or sell an asset at the future date for a fixed price. As I said, swaps and forwards are almost similar like futures contract, but only difference is how well and precisely are they defined. The best defined are futures contract, and because of that, they are mostly traded. They are one of the mostly traded products on the earth. We use derivatives for risk management, speculation, and access to new markets. We can also use derivatives for doing arbitrage or price discovery of some products. Okay, this is like in theory, but now I will show you one really simple real-world example, imaginary, but I think you will understand how futures contracts are working. Let's imagine there is a farmer who has 100,000 kilos of corn. Let's suppose that 1 kilo of corn is cost 1.5 euros. And at that moment, price of that of his corn is 1,500,000 euros. If that, but that farmer want to sell that corn in the 2 months period, but he is not sure what will happen with that price. He is satisfied with this price of 1,500,000 because he can cover all of his operational cost. He can pay for land, for the seeds, for the fertilizer, and make profit. So he can run his business. But if price of corn went down, then he will not be able to run his business, and maybe he will go in bankruptcy. To hedge that risk, one of the options is to is to sell futures contract. And let's imagine that he sell or short corn futures, which has delivery in 2 months. Then let's suppose in 2 months, price of corn went from 1.5 euros to 1.3 euros. Then that physical corn now doesn't worth anymore 1,500,000, but is worth 1,300,000 euros. That is 20,000 euros of loss. But on the other hand, he will make that 20,000 of euros by shorting futures contract of the corn. So these two positions cancel each other. And he will be able in 2 months again make 1,500,000 euros in spite of physical corn losing its value. This is why futures contracts were invented at the first place, and they were used by farmers and people who need to hedge risk of the changing the prices on the global markets. Now we are using futures for many more things, but the main purpose of futures and the big part of their trading is still hedging of the global commodities. Okay, now we will keep understanding futures contract, and one of the main thing of the futures contract is how well they are defined, or let's say case specification of the futures contract. So case specification are underlying asset, contract size, expiration date, price quotation, code, ticker, and delivery. To better understand those concepts, I will show you one real-world example, and this is crude oil traded on CME, Chicago Mercantile Exchange. So every major global exchanges has listed futures contract and detailed K specification. So if you go to CME page, you will be able to find this product, but you will be also able to find a specification for gold, for S&P 500, for 10-year bonds, for Bitcoin, and it's same for every other global exchange. Here you can see those items, those case specification. You see underlying asset is crude oil futures. After that we have contract size. Contract size of oil is 1,000 of barrels. That is 1,600,000 liters, or about, if we calculate the price of a barrel, which is around $65 today, this contract is worth $6,500,000. The next one is price quotation. Price quotation is telling how price is moving. We are saying when we are talking about price movement, we call those price movement ticks. And if price move, let's say 3 ticks, then if trader buy that futures contract, he would made 30 euros. But let's say if price went down 5 ticks, then trader will lose $50 on that trade. And also you have that defined here in the price quotation. The next one is code or ticker. Because this one is a global traded commodity, it's one of the most important, then everybody in the world should know how it's called and what crude oil stands for. The ticker for crude oil is CL, and if you want to check the price of crude oil, you can go TradingView on Bloomberg or wherever you want and just type CL and you will get price of crude oil. Then two really important things are expiration date and delivery. Expiration date telling us when this month is ending and the next month is start to trade. And the delivery is telling how delivery process is handled, where delivery will be done. And you can see there is many more details. So it is really important to know all details, because when some bad things happen, if you don't know all the details, people can lose a lot of money. Now I will show you one example. Probably most of you heard about it when price of oil went negative. I would make some analogy. Let's say that you go to gas station and you fill up your tank. And after you go to pay on that gas station, they actually paying to you because you fill up your tank. That's actually what happened in this crude oil. This happened at April 2020 during coronavirus pandemic, and here is 0. Here is worth of 0, and here is minus 40. And this thing that happened doesn't make sense for many people, but for those who understand very well how delivery process, how expiration date, and all those details, for those people, this make perfectly sense. But many people thought that price of crude oil can't go below 0, but actually can't. And if you want to know how that works, you can check. I don't have time for explain all details, but I just want to show how some strange thing can happen in the futures market. Okay, next thing I would like to talk is supply and demand dynamics in the futures. Every commodity has a supply chain that involves the process of production, transportation, and distribution. Things that can affect supply and demand dynamics are geopolitical events, production cost changes, number of producer, customer trends, and inventory levels. To give you a better picture, what does this mean, I will use again example of crude oil. As I said, crude oil is one of the biggest and most important global commodity. It is used to produce gasoline and diesel that used for transportation and producing electricity, but also for producing things like plastic, food, cosmetics, fertilizer, and things like that. Because of that, it is one of the most important commodities for our society. The biggest producer of the oil are United States and OPEC countries like Saudi Arabia, Russia, and Iran. Here, you can immediately see that geopolitical news can really affect price of the oil. So, instability in the Middle East, terror attack, things that happening with Houthis, how they are attacking, how ships that they are carrying oil, all new politics, and all those things can affect what's happening with global oil market. Then we have transportation and logistics, and on the other side we have customer trends and some kind of policies. Let's say green policies. How green policies affecting price of the oil? What's happening with electric cars and things like that? All those things affecting price oil. And now we will take a look at the first case study. That is Russian-Ukraine crisis and the effect to oil markets. To better understand Russia-Ukraine crisis, we will take a look a little bit into the context. At 2040, Russia annexed Crimea, and in 2020, there was invasion of Russia, launching full-scale invasion to the Ukraine. Why this is important to the price of the oil? Russia is the third largest producer of oil worldwide, contributing to over 12% of the global producing of the oil. Then, after the war, sanctions are imposed to Russia. Here you can see there will be problem in supplying. So there will be less supply from Russia, so price of oil should go up. Now we will see what is market context and scenarios. Russia start to build big troops around Ukraine border. And Western journalists, intelligence, they saw that and they start to noticing strange patterns happening. So everybody start to expecting some kind of invasion. And the first one write that on Twitter. People start to noticing and write down about possibility of war. And even nothing happened. Now I will show you how market react. So here you can see date, and it was before invasion, but still, after this tweet, you see how price of oil went up, just on rumors about invasion. And this is kind of big move. Price went around 3 to 4%. This is VTI crude oil. This one is US crude oil, let's say. And this one is Brent crude oil. That is global benchmark for crude oil. And both of them went up, but move in the crude oil was a little bit bigger and a little bit stronger than the move in VTI. Also, S&P index, that is S&P 500, the biggest US index, actually on this news went down, because if there is war, that would be bad for economy. Okay, now we will talk about case study number 2 and the impact of Trump tariffs. As you probably, most of you know, there is big tension in between China-US relationship. The first question, why do those tensions exist at the first place? So first thing is trade imbalances. US has huge trade imbalances with China. So they are importing much more things than they are exporting in the China. The next thing is intellectual property theft. There is accusation from United States that China is stealing their technology, replacing it, and then selling like their own. Then market access. There is so many US company, they don't have free access to the China. Then there is geopolitical rivalry. US is still the #1 forces in the world, global superpower, but China is challenging that status. And the next one is military tension. Like you see, there are big tension around Taiwan. China want to invade Taiwan and take it as their own, but US decide to defend Taiwan from China. President Trump, when he came to the power at 2016 or 17, he was saying and threatening to impose tariffs. And actually, he did that in 2018, but those tariffs were not so strong and not really serious. But when he came again in 2024 in the power, he decided to put huge and strong tariffs on China. And that Trump 2.0, how they call him, was much more serious about those tariffs than he was before. Probably you know, when he put that his board, he was saying about 70% tariffs on the Chinese goods, and he was threatening with that number. China was threatening with counter tariffs, and that situation was kind of really, really bad for whole global economy. But little by little, US and China delegation come to table and start to negotiate. And after some time of negotiation, they actually agreed about 10 to 15% of tariffs. And after that happened, it was a sudden move. This is how market reacted. Here, I put a few on the main products. First, this announcement happened on 12th of May at 9 o'clock in the morning. This was an unexpected move, and because of that, it was there is so strong reaction in the market. Here we will take a look on oil, ICE Brent, so-called. Then you have S&P 500, the biggest US index. After that, we will take a look at China A50, China stock index. The next one is US 10-year bond, and then here is gold, and after that we have US dollar index. Now, before keep with presentation, I would like, did anybody of you do any of trading? Do you have some experience in trading, or do you do trades by your own? Anybody? Please raise your hand if you do. Okay, 1, 2, 3. Nobody else. Do you follow maybe geopolitics? Does anybody know or understand, can give me explanation why this happened? Do you know what is in behind? Why indices reacted so strong? Okay, anybody? So here is the thing. Because they agreed to much lower tariffs, that means that lower tariffs would be good for economy. There will be a lot of trading, and because of that, US company would make much bigger earnings. Also, Chinese companies would make bigger earnings. That drive price of those companies up, and also US indices and China indices. If there is no tariffs, there will be more business between those two countries, so both countries would spend more oil. Because of that, price of oil went up. Here is the dollar index. If there is more trading, there will be more demand for dollars, because US and China trading in dollars. There will be more demand that drive price of dollar index up. Gold is well known like safe haven, and usually gold going up in the time of crisis. This is opposite of crisis. This is good situation for the world and for China and USA. Because of that, gold went up. Also, US treasury bonds are considered like a safe haven. People buying bonds where there is a risk on the market. So people decide to sell the bonds and take that money, put them into the equities and some kind of riskier asset, let's say Brent or oil. One really interesting scenario that can happen is what would happen if China invaded Taiwan. Analysts was thinking about that, and some things, some scenarios that global stock market, short-term decline, so probably all equities, all stocks would go down, like that happened in Russia-Ukraine war, because there is instability in whole world, so probably whole stock market in the short term would go down. The biggest hit would be to technological sector, or so-called company TSMC, Taiwan Semiconductor Manufacturing Industry. And they have most of their factories in the Taiwan, and they are producing chips there, so probably their stock would take a really hard hit in the case of China invading Taiwan. People would probably go to the safest haven. They would try to buy safe thing like US dollars. The next one in non-Taiwan semiconductor companies like Intel or Samsung would perform a little bit better, because then everybody would switch to them and try to buy chips from them. Also, defense industry stocks like Lockheed Martin or Northrop Grumman would go up, because during the war, people used to buy a lot of weapons. That is thing. Okay, we did 2 case studies, and I show you what happened during Russia-Ukraine crisis and during US-China tariff tension. Now we will take a look into the economic data and market sentiment. Economic data are case statistics that are showing how some economy perform and what is health of the economy and what are the future trends. They are published by some government agency, or some financial institution. And we have all kind of economic data which showing us inflation, GDP growth, consumer spending, and things like that. Some of the most important economic data, or a few that I decided to put in this presentation, are retail sales. Those numbers are showing how much consumer spending, how much money consumer spending. Then after that, GDP, that is gross domestic products. This one showing what is the rise of economy of the country. After that, NFP, non-farm payroll numbers. Those are showing what is the increase of the number of jobs in USA. And the last one is CPI number, or measure of inflation. Market sentiment is not always rational and can be influenced by collective mood of investor. We have so-called risk-on sentiment and risk-off sentiment. Risk-on sentiment is sentiment when investors are taking risk. It is good time and people are buying riskier assets like stocks. But risk-off sentiment is when times are riskier, when there is some crisis in the world, or there is some kind of war or something in the world, or something like that. And the people usually during that time selling riskier asset like stocks, or buying some safe asset like gold or government bonds. Now we will try to see and a little bit better understand some of the economic reports. First one is Consumer Price Index. Does anybody know what is Consumer Price Index? What does CPI stands for? Anybody? Yes, what is CPI? Measure of inflation, okay. And do you know some other details about CPI? Do you know what is inflation right now? How big is?
It's around 4% in Croatia.
Okay. Yeah, probably around 4% in Croatia, maybe like 3% in USA. But it's changing every month. And maybe you know, but just a few years ago, inflation wasn't such a big thing. And it was all the time around 2%. But everything changed with the coronavirus pandemic. During that time, central banks start to print huge amounts of money. And that caused a spike in inflation. To fight that, central banks start to raise interest rate. And now we have a time of high interest rate. Those high interest rates, in theory, are not good for economy. And now everybody is considered what will be in the futures with inflation. Would we have some kind of persistent inflation? Will be there inflation for 5-6% for a prolonged period of time, or this is kind of temporary inflation and will be and there will be no inflation in a few years. So consumer CPI, now everybody looking for CPI numbers to see what will happen with inflation and what are the future trends. The next one is non-farm payroll, and this number shows how many jobs were added in the US economy. What do you think if we have a higher inflation number in CPI? What will happen with the market? How market would react if everybody expect like 3% inflation and there is 4% inflation? What will happen with the markets? Does anybody have idea? Yes?
Employers will try to cut their costs.
Okay.
By other hiring people or
Yeah, my question is, what will happen with S&P 500? Will S&P 500 go up or down on the higher or lower, let's say on higher inflation report? What do you think? Yes?
Maybe up, because people will not want to have cash on hand, so they will invest everything in the market.
Okay. Yeah, you say it will maybe go up. Does anybody has any other idea where it will go? Does anybody think it will go down? Okay. What do you think? What will happen with the market on non-farm payrolls? Non-farm payrolls is a job report from USA. And if non-farm payroll is higher, that means more people get a job last month in the USA. How market would react on higher non-farm payrolls? What would happen? What do you think will happen with S&P 500 index on higher non-farm payroll numbers? Anybody has idea? Yes?
React positively because it shows a healthy market.
Okay, so you think S&P would go up because that show how market is healthy and bigger numbers are good for market. Okay, let's now see what happened with inflation. Okay. Here you can see US CPI data. It is from February. This is date 12th of February in the 2:30. Here you can see actual number, and here you can see forecast number, and this one is previous number. So inflation for January in USA was 3%. And you can see how market reacted. It went sharply down. So why this happened? Because if we have high inflation is kind of bad for the economy. If you have high inflation, that means US central banks will rise interest rate or keep interest rate high. If you have high interest rate, there is no much credit in the system. It is hard to get money to start the business or do things. Because of that, higher inflation numbers are considered bad for the economy, and because of that, market went down. But in trading is not so simple, and you have time when you get higher inflation number, but market would go up. Here you can see from the April 2021, during that time, at that time you had inflation of 2.6%, and the forecast was 2.5%, but market went up, actually. There is good saying that market can be irrational much longer than you can be solvent. So in the trading, the most important thing is to watch for the risk limit. Now, as we talk about non-farm payroll, as you remember, this is a report from the last Friday. Non-farm payrolls are reported every first Friday in the month from the previous month. And here you can see the date, time, and number. So actual number was almost 140K, and the expectation was 126K, and the previous number was 147K. Here you can see how market reacted, because this was kind of a really big beat, almost like 10%. Market went up. There was a little bit consolidation, and then kept going up during the day. Okay, and that would be most from my presentation. We went through some cases. At the end, I would like to recommend some books if you want to learn a little bit more about trading. There is good series, so-called Market Wizards. The one classic that everybody in our company is reading is One Good Trade. Then Alpha Trader is a little bit more technical books, and the Trading in the Zone is much more about psychology of trading. Okay, thank you for your attention. Here, if anybody is interested in trading, or you would like to come to internship or try trade on the markets and see how that's working, I would recommend our internship, and you can scan this QR code that will lead you to our page, and there is like application for internship. That would be it from me, and now I'm listening your question. Do you have any question for me? Okay, if you want to know something about trading, about markets, about our company, feel free to ask. Okay, I'm listening.
What's your information about trade?
We have trades that last for 1 second or maybe even millisecond when you put orders up and down, but we also have trades that last 1 day, 3 days, 7 days. It all depends on trade and depend on trader. Some traders like to take much longer position. They are like swing traders, and some traders like to scalp volatility in the market, and some of traders are doing both things. And there is a lot of different type of trades and different type of markets. There are fast market which are moving very fast, and there are really slow market or illiquid market that they are not moving. So it depends what kind of trade are you taking. Trade can last from millisecond to, let's say, 10 days or 1 month. The thing that people also very often ask us, are we algo trader? And we in positive equity, we are not algo trader. We are not writing code to trade for us. We are so-called discretionary trader. Every trade that we are take, we put, and we have some software that help us with entry and automatization, but we are not algo trader. We are so-called discretionary trader. Every trade we put, we need to put orders to enter and to exit. Okay. Any more questions? Reci.
When you earn money,
Yeah.
someone need to lose something. Who is losing when you are earning?
Yeah, there is question who is, when we are making money, who is losing money, and that's kind of philosophical question. It is not hard to explain it. Sometimes somebody is losing money when somebody else making, but I think there is also possibility to everybody make money, because I think there is every year more money in the system. So central banks and they are printing money. There is more credit. So global economy is rising. And I think we are not just stealing from anybody money, but we are taking a little bit of money, and the traders making market much more efficient. That is how we. That's our, I would say that what we are doing. So that is kind of a little bit philosophical question. I'm not sure who is making money, who is losing there. Okay. Any more questions?
For you at positive equity, is it better if market goes sideways or if it's very volatile?
Usually for us is the best when market is very volatile. Then we are able to make the most money. But some people are kind of calm traders. They don't like too much volatility, and they like to trade when market is slow. But generally, it is a little bit easier to trade where market is really volatile, because during that time, I would say, I'm not sure that is true, that algo traders and they turn off the trading, or they are not trading so much, and there is less competition. So we are able to trade, and during that time, they are not able to price some things, and it is really hard for him and really dangerous for them. But humans can, based on experience and some kind of feeling, can price it that a little bit better. I would say like that. Okay, any more questions? So, no more question? Okay. Thank you for your attention. That would be it for me.
Thank you so much for coming to the lecture. Thanks, Dominic. And if you have any questions, you can ask on Discord. And this lecture is also filmed and will be posted on YouTube. And if you have any questions, you can put it in the comment section. Yeah. Thanks so much for coming.
Это